Good morning, good afternoon, or good evening, wherever you're joining us from around the world. Welcome to Web3 Warriors, episode 44, featuring Emmanuel Daniel, author of The Great Transition. The Personalization of Finance is here. Thank you for joining us today, Emmanuel. How are you doing today?
Great to be with you, David, and thank you for making this happen on a well, it's my Saturday afternoon here.
No problem. Appreciate having you here. I'm really excited to get into it. So today for episode 44, I'm David Krome, your host. I go by Krome in the metaverse, and we're going to be talking about really continuing the conversation around kind of the theoretical angle of the blockchain and the evolution of our economy, and really the decentralized and more personalized and autonomous economic opportunities for people through the blockchain. And really it started with a conversation about the metaverse and the future of kind of societies adopting the metaverse and jumping into this digital space in a real way, which we had Dr. Jane Thomason on, who's kind of a leading thinker in this space when it comes to the metaverse. And then after that, we had a discussion around CBDCs in the last episode 43, really looking at kind of the good, the bad, and the ugly, and the potentiality that CBDCs are a kind of Trojan horse for this Web3 space and what we're trying to build here, and keeping things decentralized, and whether we'll be able to continue to move in that right trajectory and continue to take advantage of these awesome opportunities that decentralized peer-to-peer transactions and trading, and really just the whole NFT marketplace on the blockchain is creating for people in different corners of the world, right? So that's an interesting evolving space that we're going to continue to watch, looking at central bank digital currencies. But now looking at really the broader topic of the personalization of finance, and the idea that there is this great transition from, these central banks and these institutions kind of defining how we move our money, how money moves, and kind of being at their whims, and often having to pay big fees in order to make your money move, to now being able to actually just directly peer-to-peer trade with people all across the world in a very much more frictionless way, in a much more personal way. So that's what we're going to get into today with Emmanuel here. And really, he's got a background in traditional banking. He's got a lot of connections. He's out there in the circuit really trying to press the flesh with regulators in different countries around the world, it seems, to actually talk about, what is this transition? What are we kind of moving towards with the blockchain, but also with fintech in general, right? Which is financial technology. How are things evolving to become more accessible, to become more decentralized, and more empowering, really, to the individual, right? So that's really an exciting kind of opportunity to pick the brain of somebody who comes from the traditional banking space, but also sees the value in blockchain and sees the value in Web3 and what we're trying to build here. So it's really exciting. Thank you again, Emmanuel, for joining us. And maybe before we talk directly about your book and The Great Transition and the Personalization of Finance, I'd like to get a little bit of background on yourself and, what brought you to the blockchain and what brought you to this perspective. So thanks for joining us.
Yeah, thanks very much for having me, David. So, just to dive right in, I come from the traditional banking industry, and all of your viewers and listeners are in Web3, your Web3 native people. And I started life by starting a platform called The Asian Banker out from Singapore, looking out to all the traditional banks, across the Asia Pacific region. And this was in 1996, right? And that was the time when banks held forth. There was nothing outside of banking. And everything about innovation was about how banks were trying to innovate, from the good old days of the ATMs to internet banking to call centers and all that. And so, it was more of the same for many, many years. I think that as Web3 sort of, usurped into the equation and started to disrupt the idea of finance, it took me a long time to absorb the ideas and then to lay out what I think to be a roadmap. If you think of me as a believer of Web3 and what it promises to do, I'm like the guy who believed in Christianity without ever having heard the name Jesus Christ. Okay, so your listeners are, Web3 natives. They, you talk the language, you know the stuff and all that. And I've arrived at the same point as all of your listeners, except that from a world where we not only didn't know enough about Web3, but also didn't want to accept the transformation that was taking place.
Right.
So in all of the 28 years, I went through a journey, trying to, put in perspective what innovation would look like. And so this book that I've just published is in itself part of that journey. In fact, it took me many years. I wanted to write about what innovation in banking would really be, but I was learning as I was writing. And so there are many things that I say in my book. I say that we need to make a distinction between the industrialization of finance, the digitization of finance, and the personalization of finance. They are three very different things. When banks do many things better, faster, cheaper, that's the industrialization of finance. So sometimes the banks talk about blockchain as if it's meant to make what they already do cheaper. They think about blockchain back office function that in the old days they used to all have their own ledgers, and now you can have a shared ledger, therefore you reduce cost of operations. Now when they talk like that, they're actually talking about something totally different from what your viewers talk about.
Right.
And then digitization of finance was about the platform era. The banks wanted to be able to be as successful as the Amazons and the Microsofts and the Facebooks of the world. They wanted to be platform, successful on the platform technology. So what I'm saying to them is that the platform, and I'm probably saying the same thing to your audience, is that the platform technology itself is in transition. And today, when I talk to, in fact, I showed the draft of my book to people at Google, and they pushed back on the idea that we're actually seeing the decline of the platform economy, and that we're seeing the rise of something I call the personalization phase of technology of the economy. And I'm also saying that as we become increasingly personalized, that the token and the value carried in the token is going to make the individual the powerful part of the equation. So it's no longer the platform players, it's no longer the institutions going forward. So this book, this whole conversation I'm having with you is actually a description of my own personal journey in getting to where we are today.
Wow. That's pretty interesting. And I think the fact that Google would even push back on it, I mean, basically it seems like central authorities, for pretty obvious reasons, have their concerns with the disruption that the blockchain presents, right? And I think you're viewing that disruption as kind of an empowering tool, right, for that personalization of finance, which definitely is completely in line with what we talk about here at Web3 Warriors, which is really the idea that the blockchain is empowering creators and really builders of all types, not just artists, but anybody who wants to kind of put their creations on the blockchain and sell it. What you're talking about is even taking a step back from that, and the fact that people can assign value, right, in this new kind of tokenized economy and create basically a chain of value and a whole kind of economy, micro-economy, you could say, just by kind of agreed upon set of tokens, for example, whether that's Bitcoin was clearly like the most obvious and kind of successful network effect example of that. So I guess, how do you view that kind of adoption going forward, right? Because I think that's where you see a lot of the hesitancy from the Googles, from even the Facebook, and obviously the central banks, the traditional banks. They just want to improve their processes, but they don't actually want to empower the person. So how do you see that evolution kind of playing out right now, or how does your book kind of look at that kind of evolution?
So actually, what I do is say everything that you've just said and translate that for traditional bankers to understand. When Google pushed back to my idea, it does not mean that Google is not invested in, experiments in R&D, in all of the elements of personalization. And one of the most important elements in personalization is identity. And there's a lot of work that is underway that Google has invested in, on the identity front. It's just that they don't want to go there for as long as the power of the equation or the power of the relationship sits on the platform. In other words, you and I have to go onto the platform to exist, as opposed to the platform has to come out to look out for us, and that we decide who we want to interact with and the networks that we want to create. So that's the devolution of power from the platforms to the individual. And by translating everything that you are saying for bankers, in fact, the cover of my book has the picture of an ice cube.
Yeah.
So
that was one of my questions, actually. What was that ice cube all about?
Yeah. So in order to simplify the ideas and then build on the complexity of what needs to happen to make them happen, make the whole process take place. So I'm saying to bankers is this: think about the ice trade. Okay, in the 1750s, ice was about sawing it out of the lakes of Michigan and where you are in Canada, right?
Right.
And Boston and so on, and then putting it on horse-drawn carriages and taking it into the city where you find an ice cube plonked into gin and tonic, at a cocktail, and then on to the ice merchants who manufactured it in big warehouses. And every time I see one of these old ice merchant warehouses, you can actually still see them in different parts of the world. I actually take photographs with them because I want to tell bankers this is what your institution is going to look like in the future. And where do we get ice from today? In the refrigerator at home, when we want it, where we want it, how we want it, and how much of it we want. And when you think about what finance is today, it's like in the old days of the ice trade, where the money in your pocket might have actually swirled around the world before reaching you. It would have gone through the global payment network, get processed, get checked for, KYC, know your customer, and then it goes. It's subject to inflation, the economy, trade,
right.
FX, and bank charges and risk before it gets to you. Okay, that's money today, and I'm saying that we are now moving into an age where we can visualize money as being a token or an asset generated by the individual and then shared out to the rest of the world. And as I do that, as I'm explaining how money, the idea of money is changing, and the idea of exchange is changing, and the idea of value is changing, I'm actually also trying to work out the elements that need to be in place, the technology that needs to support that as we get there. So what I'm saying to bankers is that as money gets personalized, the beauty of cryptocurrency, okay, and I use very little of catchphrases like crypto or Web3 in my book.
Right.
I need to old-fashioned as possible, using language that bankers understand, and then taking them on this journey. So what I'm saying to them is that the beauty of crypto is not that Bitcoin went up to $60,000, $65,000, or it's now worth nothing. I mean, like a lot less than that. The beauty of crypto is that all of us, you can create your own crypto. I can create my own crypto. Everyone around me can create their own crypto. That technology already exists today. And the fact that we today have any number of cryptos being created to raise capital, to design functionalities, and to create communities around each one of them is a phase in that journey. And so when and what's stopping us from each of us creating our own crypto is because after we have created it, we're going to have to float it and then see who would want to interact with us and accept our crypto and make that interoperable with other cryptos and so on in the network effect, right? So now we are still in the process of building that, but that reality already exists today, and the pushback on that reality is that, firstly, the banks as institutions don't want to give up the intermediation game that they're in. The platforms don't want to give up their role as also as intermediaries, as exchanges, and so on. But in banking, okay, and this is something that people in technology may not be very mindful of, is that even right now, all that is happening in the crypto space. The original crypto players wanted to be exchanges, and today it's not profitable to be exchanges anymore. And then they changed their language to say we want to be custodians, because the individual is increasingly in control of the assets that is created, and that's also not very profitable. And then you get hard cold wallets and so on, and wallet players and community creators and so on. So
Right.
so you can see that even in the Web3 universe, that control, the centralized control, is already starting to morph. Even as we are trying to get traditional bankers on board, the players in the industry that you're in, which is Web3, are already morphing towards personalization. So these are the issues that I'm capturing. And another issue that I'm capturing is how value is created and captured. There was a time in banking in 1984 when the first savings and loan crisis took place. When you looked at the balance sheet of a bank, it contained hard assets. It contained mortgages that borrowing from their customers on the balance sheet of any traditional bank in North America, in the community banks and the large transnational banks and so on. And then it started morphing. Banks started building more securities on their balance sheet. The hard mortgages, they started, putting them together and hiving them off and selling them off as assets, and then, locking in the income that was coming from the hard assets. So by the time we reached the 2000s, the balance sheets of financial institutions were already morphing. They were becoming increasingly ephemeral. And that is why by the time 2007 came about, you saw that banks got into trouble because of trading assets, which they themselves don't know how much trading assets they carry on their books, because that in itself is leveraged, and then out and traded and played like musical chairs between the different global banks. So today, banks carry an incredible amount of intangible assets. And much of the banking assets today, they're intangible because they were in the first place able to be digitized. And then from being digitized, they became financialized. And that's what is reflected on the balance sheet of banks. And so when I think about NFT and the idea that there are thousands, if not millions, of people around the world today putting out creative objects, assets, and assets that is of value to themselves, and putting it out into the network and saying what is it of value to the rest of the network. And then to see buyers and sellers, do a price discovery process to discover the price. That's exactly what's happening in finance, in banking, in traditional banking, but in a very different way. So the two universes are getting to become parallel, and the technologies that hold them are actually not very much different from each other.
Yeah, exactly. No, that's great. You hit the nail on the head. And it's interesting when you look at like decentralized finance, DeFi, as we call it in the space, and they basically took all of those kind of backroom banking games and brought them into like the public essentially, and let people play their over leveraging and staking and getting certain kind of benefits from investments. And then it's a lot, and that's kind of the side of DeFi and Web3 and blockchain that I personally don't mess around with too much because I don't have the kind of liquidity to be like doing too much DeFi stuff. But at the same time, I applaud the fact that they've taken a lot of these things that bankers were kind of doing, like about it because you're from the space, but most people don't realize how much their money is just tied up in all these games and hedge funds and all these other stuff, right? So like you said, they're kind of mirroring each other for better or worse. People look at FTX, right, the most recent explosion, and I've heard people say the comparison, certain banks, if you went running to them and demanding all your money right away, they'd be in the same scenario.
Yeah, exactly. Now, David, I want to say something to your Web3 listeners, okay? And this is something very important for anyone in the DeFi space. Avoid the temptation of naming DeFi products with the same language that traditional banks name their products. okay, leverage, lending, payments. Okay, now I think and I say this in my book, that this is where the peer-to-peer players went wrong. I call them the first iteration of the peer-to-peer players. The platforms that were created to bring borrowers and lenders with each other to meet each other, and investors and borrowers with each other. Now, the 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 error of the first peer-to-peer player platforms was that they predicated the language of their product in the same language as bankers call their product. So peer-to-peer lending platform that sold, or rather brought a borrower and lender on a mortgage would call that product a mortgage. So we sold, $200 million worth of mortgages on our P2P lending platform. But see, it's precisely because they predicated, or rather they structured their perception of the product as banks do. Eventually, the regulators came in and said, look, if what you're selling is mortgages, we're going to throw in all the regulation that is necessary for regulating anybody who raises a mortgage. So you need to have capital, against your lending. You need to have the same risk profiles that the banks have. And then the peer-to-peer players found that they were inundated slapped with the same costs as banks were. Yep. And that's where they. Okay. Now, what is peer-to-peer lending? Peer-to-peer lending is bringing together both sides of the equation with the borrowers and the lenders, and generating incredible amount of conversations from which you can design new products, the products that never existed in the physical realm before. And especially when we think about young people today who are not interested in a 13-year mortgage of a physical house that they're going to live in for the rest of their life. They're talking about being able to lease a property, use it for their lifestyle needs, juxtapose it with other needs that they have, and to be able to be liquid financially and to be mobile, right? So now all of these aspirational values that exist in today's society is able to be captured in the conversations that take place on platforms. And on the network effect as well. It's the more we have, the more data we have, the more we are able to imagine new sets of products that didn't exist before. So this is what I'm saying to DeFi players. Don't construct your idea of products in the same way that traditional banks did. Take into account all the conversations that are taking place in the networks today, and design products that reflect the aspirational values of the people using them. Now that's going to be even more possible as when we go into increasing processing power, AI, processing data, and so on. That we will be able to identify trends from where we will be able to design new products that never existed in society before. Okay, so that's something that I think that the DeFi players need to think a little bit about, to let the data speak to them.
That's fascinating. I hope that any DeFi listeners out there are taking that into heart, because it does make sense. When I hear a lot of their language, it does seem to just be borrowed from the banking. And I think the mindset was, let's show that we're doing everything they do, but we're doing it out in the open and accountably, right? And so, maybe the goal, to your point, should be not to do everything they do. Maybe you're doing it in practice, a lot of the similar, type of actions in order to create value, but call it something else, right? Because then as soon as you call it a mortgage, or you call it, something that has all these regulatory kind of elements attached to it, right? You could call it something brand new. It serves the same function. It's interesting. I feel like the SEC and American regulators especially tend to really be reaching into the blockchain a lot more than some of the other jurisdictions. And so they really are concerned with exactly how these different digital assets are being labeled and how they're being sold. And are they a security, or are they a digital asset? Are they a collectible? It seems a little bit over the top to me. Really a great point on DeFi. I think that there is a little bit too much of wanting to simulate banking in the traditional sense. And why don't we shake things up and redefine terms completely? Yeah, it's a great point.
So in order to help, all of us understand where we are heading, the last two chapters of my book, I actually borrowed an idea from an intellectual I totally admire. His name is David Ronfeld. He worked for the Rand Corporation in the 1990s, and it was 1994 he came up with a paper that said that society as a whole goes through a transition across four phases. The first phase is we're all tribal, and then second phase is we institutionalized, our tribalness. We have education, we have the church, we have the bank. So we go through an institutional phase. The third phase is society goes into what he calls the market phase, where we're able to buy and sell from people we don't know around the world. So we create a market economy, and that's where we are today. And then the fourth phase. And he wrote this in 1994 when the most developed technology was the fax machine. Okay, and he said we will then move into the network phase. So what I did was I took his ideas and I overlaid that on banking, on finance, and then I said, oh my goodness, I'm able to explain a lot of the transformations taking place today in this context. In fact, some of your listeners may not be aware of this, but there was a crisis just 12 years ago called the LIBOR crisis. Well, it's more than 12 years, 14 to 16 years. It was a long drawn affair where the rate setters in the UK, the leading banks in the UK, they get together and they set lending rates, and that was to benchmark the borrowing cost in the UK. But the traders came around them and said, "Oh, you set this rate. We want to use that, in order to trade it as we want to use the index that you create as a trading asset that we can put out there in the market, and people can bet on it." And these two categories of people were operating in two different dimensions. The rate setters were in the institutional phase, and the traders were in the markets phase. And whenever we go through a transition, one phase always tries to influence the previous phase, or the previous phase may not understand what's going on in the new phase. So now, when I use that paradigm to explain what's happening today, so this is what I'll say to you: that everything that Charlie Munger and Warren Buffett says about Bitcoin today is true as a trading asset, okay, as a security. So you have to lump them in together with with shares, with bonds, with alternative investments, and the impact of inflation, the markets, cost of funds, Fed rates, everything, how they influence. And you can put in the checks and balances, so that people don't get their investments burnt and so on. So you're actually talking about the markets phase in the evolution of society. And the rules apply to everyone the same. So, what the SEC says is also consistent, because they're looking at this token and saying, is that a security, or is that something that facilitates transactions? And so the questions they ask in that phase are valid. Now, what they're not thinking about is what will all these assets look like when we finally transition into the network phase. In the network phase, the most important commodity in the network phase is information. And information behaves differently from a security or a mortgage. If I sell you a house in the market space, I have to make sure that I get the highest possible profit from it, and you must make sure that you're getting good value for the transaction, because once the transaction is completed, I lose the house, you gain the house. There's a winner and a loser element in there. But information is the only commodity that increases in value the more you share it. So when I give you information, I don't lose it. I still have it. When you pass it on, you don't lose it. And then it becomes more valuable when an entire network has use for that information. That's when I become powerful. I've never lost it by giving it away.
That's a great point. I like that.
That's value in the network phase. That's what generates value in the network phase, right? So, and the rules there are totally different from what Warren Buffett is familiar with today. So we need to understand what is it about Bitcoin or any of the crises that are taking place today. Like the FTX episode actually cast aspersions and call out the bluff of the venture capital industry,
Right.
not the technology. The technology actually has been proven to be robust, and resilient, and it grows on itself even further. I mean, Bitcoin hash rates have gone up, not down.
Exactly.
Ethereum hash rates are up, and the higher the hash rates, the more secure the network effect. So the technology is marching on, regardless of these crises. And the industry, the investment industry might go into doldrums for a while and say, you know what, we're tired of this, and then it slowly still grows on, and then it becomes a reality, 10, 12 years from now. So we need to be mindful of what it is that we're dealing with.
Yeah, very exciting. And you're definitely right. The technology cannot be denied. And I think when we look at these centralized exchanges going belly up, it has more to do with how they're using investor money and the fact that they're just overinflated, overextended, and often over-leveraged just due to all the flush money that they've been given and, often mismanaged, just like the traditional banks sometimes mismanaged as well. But on the flip side, what you're getting a lot of people...
Finish what you're saying.
I was just going to say, you're getting a lot of people now crying for more regulation, right? Like, oh, we need the regulators to make sure these central exchanges play by the books. And it's like, aren't they just like, you're just asking them to turn them into banks then? Like they're not really, taking advantage of the blockchain at all at that point. They're just becoming another flawed institution, right?
And when the regulators go in there to see what is it about FTX that we needed to regulate, they would find that what they really needed to regulate on FTX was the balance sheet, not the technology. Okay, FTX had to value its tokens, the FTT tokens, not even mark to market, because on the day that you liquidate your tokens, the market isn't going to absorb, what you're throwing into the market, especially when you hold 70% of the assets. So you need to have valued it in the most conservative manner possible. The regulators should be looking at FTX's balance sheet and taking the auditors into custody because they allowed FTX to overvalue the assets, and even if they valued it at market rate, the auditors need to explain on the day that you liquidate, are you going to be able to get the same rate? And not only did they, allow FTX to mark to market, they also allowed FTX to borrow from their own bank, at the mark-to-market rate, and therefore leverage it even further. So it was entirely a balance sheet crisis, a balance sheet episode. It was not a technology episode at all. So yes, put in more regulation on the right things, not the not the wrong things. And in fact, anyone going in and looking at the whole episode will come to this conclusion. Okay, so because the facts are all speaking for themselves right now.
And so what do you think about the leader there, Mr. SBF, and the fact that he's just doing his media circuit and seemingly not facing any charges? What do you think that's all about?
Well, about managing perceptions. In fact, in the digital space, in the DeFi space, in the non-NFT space, the value is a function of perception. Mm-hmm. We are now entering an economy where value is a function of perception, no longer a function of any form of underlying assets. And this is true of NFTs, and this is true of entire economies. Okay, the US is today more indebted than its ability to meet its obligations. Total debt in the US is 27 trillion. The US GDP is 20 trillion. Okay, the ability to meet its debt obligations is now a moot point. But yet, the rest of the world will lend the US money, will buy US treasuries, will invest in US assets because they believe in the US. Now, when will the US go into decline? It will be when the rest of the world stops believing that the US will be able to make its commitments. So we are now entering the perception economy, right? And it and it affects all of us. It affects everything. And when some of the detractors of NFTs say that, you know what, NFT is a fake economy, people are trading on perception of value, the entire economy runs that way today.
That's amazing. I love it. And so on that point, then, sorry, continue.
Actors like, Bankman-Fried, are able to take advantage of it because he's aced the game. He knows how to play the perception game.
No doubt. Wow. That's fascinating. It says something about the rule of law. Does that just come down to perception too? But, what do you say to those that look at this, and I've made this case before, the fact that Bitcoin, Ethereum, pretty much all of the crypto industry is backed by a US dollar stablecoin, right? And to your point about perception, about the fact that despite the fact that America is so indebted, I mean, a lot of other nations are in debt too, but ultimately America just has the engine, right? They got the economic engine. People believe in their engine. People believe in the idea of, the Western civilization kind of continuing to trudge on and continuing to grow and innovate, whereas maybe other corners of the world are less reliably growing or less reliably innovating. So I think that feeds the perception, right? So looking at blockchain and looking at the fact that essentially the entire industry is backed by the US dollar stablecoin, would it not be a net positive for US government, and really you could even expand it to Western governments, to be pro blockchain and to kind of position to be kind of supporting this great transition as you've framed it?
The underlying asset in the network economy that we are going into is information. There is no other underlying asset. It's information. It's information at the national level, at the level of nations. It's information at the level of companies. It's information at the level of the individual. And what the US government is struggling, what Western civilization is struggling with, is how do we manage information in a world where there's increasing symmetry of information, that the information that I have, you have, that the government has, that the individual has at the end, and how is the how our entire civilization is going to evolve as information becomes widespread, available, and easy to trade, and information is captured in data. And it's digitized data. So a company like GE, and I say this in my book, Jeff Immelt said that in 2014 that GE is going to be a data trading company. We're going to generate data from all of our manufacturing points and then make that available to the marketplace. And once you digitize data, you can financialize it. In other words, you can put it out there and say who's willing to pay for this data. Right? Now, the big thing about Western civilization is this, that although it looks incredibly dysfunctional today, it is at the forefront of dealing with how data is going to be spread out, shared widely, and yet managed. And all other economies, whether Western or Asian or whatever, are going to have to deal with what their countries will look like when more people have access to all of the data that they are interested in, whether it's data on how the government is run, data on the value that's created in finance, in industry, all of that, right? And the fact that it's dysfunctional doesn't mean that it is going into a decline. We are actually creating a new reality, and we need new rules by which society is managed. When there's symmetry of information, you take ride-hailing, for example. That's symmetry of information where the user of the ride-hailing service, the provider of the ride-hailing, and the regulator all have access to exactly the same data as to how many cabs there are out there, where they are, and what price they are willing to to provide their service. And that kind of perspective is replicated throughout all of society. And the US is actually at the forefront of a world of what happens when the common man has access to the same data as the largest bank, and so on. In fact, some of the biggest fraud incidences in banking in the last 12 to 15 years were done by individuals working out of their bedrooms. They were able to ace large trading banks, and I mentioned one of them in my book. So and then the recent Reddit revolution in securities, where thousands of ordinary people getting together could push back on market making by the institutional investors in securities. So we are seeing a kind of a evolution of the dynamics of how society holds together. So I won't say that the U.S. Will go into decline. In fact, it will redefine how we need to be organized. In a world where data is ubiquitous, it's everywhere.
That's it.
So yeah.
So with data being ubiquitous, and maybe America and a few other Western countries, I'd like to think Canada, kind of positioned in a position where that asymmetry is being removed, right? And like you say, there's like a plateau effect kind of happening where everyone has access to the same information. All you have to do is actually take the initiative to look for it. Democracies, right? Governments that are made to be representative of the people and perhaps, at least in theory, more accountable and transparent to the people, right, are going to maneuver through this transition probably a lot more safely and productively and progressively than other countries, right? And do you think that with this shakeup of data, it definitely plays a role on the blockchain, but to your point, it has much broader societal impacts, and I think it's why this whole personalization of finance is happening, right? In the end, ultimately, even Bitcoin, it grew out of everybody seeing what American banks were doing in those early 2000s, right? And if you read the Satoshi white paper, it was very clearly like precision, like even America is not infallible, like their banking shenanigans have messed up the entire international economy. So this is why we need Bitcoin. We need a stable, decentralized currency that people can use peer-to-peer without any reliance on any international government or fiat currency, right? So it was a great vision. But looking at that ubiquitous nature, maybe to your point, the West is just well positioned to actually take advantage of this huge shift, whereas it may throw entire governments into chaos, because governments that really, rely on misinformation or lies or obfuscation, basically, to kind of like prop up the perceptions around it. What do you think about that? Like, basically, is this a feather in the cap of democracy? Maybe would be a better way to put it.
Actually, it's nothing to do with democracy. The way America breaks through new frontiers in technology, in social structure, is that America is actually always, the United States is always the last believer in any new transition that needs to happen, because it holds on to the legacy that it understands for dear life until it absolutely needs to change. And it happens every single time. Okay, when you look at the evolution of the phone, for example, American phones were terrible for a long time. In fact, I was visiting the US using a GSM card, a SIM card, and the Japanese had Docomo and all of that. But and the reason America is always a laggard is because they've got so much infrastructure that they invested interest in the infrastructure that they're not willing to let go. So in payments, for example, today, the US is the most backward country in the payments sphere. And where do we find great innovations in payment? In Africa, where the Africans have understood that payments has been reduced to a transaction between two nodes, and the two nodes do not have to be a bank. They can be a telco company, and payments is a piece of information that gets transacted. And right across Africa, you've got cross-border payments. You've got you've got M-Pesa, which is basically your payment held on a chip inside the mobile device. Right. And that's your bank, and then services built around that. And then America looks at all of this and said, no, we're happy with our credit cards. And this is what my American friends tell me. We're happy with our credit cards. We are happy with what we're doing. Now, the Federal Reserve Bank is introducing new legislation for something called Fed Now that will be introduced next year, right? And that is a big breakthrough because it puts digital payments in the hands of the individual and forces the banks to all operate the same way, which is to make instant payment between individuals possible, right? And until this initiative, the banks just wanted to hold on to their float, which is the money that stays in the bank account for every day that the payment is still being processed. And sometimes it's on a check, it takes 3 to 7 days and so on. So now the thing is that when it finally comes to that inflection point, and usually it's because an individual, an entrepreneur, or an industry player made a breakthrough. So in the case of the iPhone in 2007, that put so much functionality on the device that it revolutionized mobile devices for the rest of the world. Okay, so that's how America evolves. And sometimes even in the way in which society is structured, there are societies like where I originally come from, which is Singapore. And now in a year, I spend enough time in Singapore, in Beijing, in China, and in New York, right? So we see all these three societies morphing and how they influence each other. And Singapore is interesting because it's got a Western infrastructure, legal system that is essentially Western. And so it understands Western civilization that way, right? So, and it's able to absorb a lot of the innovations taking place and then structure it within the local society. So we look very modern upfront. While America still looks, dysfunctional, and China looks like it can only make these changes if it has great control, and it's a draconian society as a result. Now, America looks at all these developments and says, "Okay, you know what? It's time that we make a change." And when it does, that's when the inflection point comes through. So, I see that America will resist changes for as long as it can until it cannot. And then it makes that leap that the rest of the world follows. And all kinds of technologies, and that's why I see this in Google in as much as we saw this in cable television. That the cable television players refuse to accept that today you can watch entertainment on your device. That you can buy it from the new network players. So. And it took them a long time to accept the role of the new players. And the new players do not need to dominate the industry to become like 50%. Even at 10%, they will start deconstructing the price points, and then the revolution takes place, right? So I think that both at national level and as well as technology levels, this is the kind of transition that we see the U.S. Leading the rest of the world. It doesn't until it does.
Wow, that's really fascinating. I appreciate that. Definitely pushes back on a little bit of my perception, and it makes sense. I remember back in Obama days when the broadband push, out here in Canada, everyone had cable internet already. Everyone was using broadband, and in America, it was apparently still 20% or something was at broadband. So Obama had this big push, we're going to get broadband to everyone. I don't even know if they still to this day have broadband everywhere, but it was just an interesting example to your point that they do seem to take their time, kind of slow walking, adopting certain innovations. But then when they do adopt it, they kind of go all out, and then it becomes kind of the trend for the world, right? So that is very interesting.
The reason for that is actually because America is also the country that raises the most amount of capital for anything, right? If you take space, spaceships, for example, the amount of capital that SpaceX is able to raise and therefore build the world's largest rockets that can, with a huge payload, the largest payload that it can carry, is far greater than anything that any other country in the world can achieve. Countries like China and India today provide services to commercial services for smaller countries to put their satellites on their rockets and send them into space. But none can do it as cheap as SpaceX today, simply because of the amount of capital they're able to raise, and therefore they're able to dominate when they want to. And then after they dominate, because of the capital that they raise, they're not able to move to the next level until there's capital destruction and then reconstruction for the next phase. In other words, investors are willing to bet on the new technology that's coming on stream until the investors who have already invested, divested and then let's start to see a decline in the capital that they provided.
I feel like you're just explaining the innovation engine of America, and it's really fascinating because on one hand I can see how there's a lot of room for criticism, but at the same time, time tested, it seems to be playing out not so badly for them, really. Push comes to shove, there's always some hard learning lessons, right? But ultimately they also battle test things, and they kind of take their time with it. Really, really exciting. So what are your thoughts? I have like 3 other questions I really wanted to get to you. I know we're hitting the 1 hour mark right away, but on the CBDC question, right? The central bank digital currency, how do you feel that project kind of plays into this great transition and the personalization of finance? And do you think that central bank digital currencies are anything other than, digital fiat? Do they still have all of the same kind of negative, inflationary issues that general fiat has? And how do you see them kind of butting up against Bitcoin and blockchain?
Actually, I'm very interested to know what your previous guest spoke about CBDCs, because I'm probably the only person in the world who's making this affirmative comment or very bold comment that CBDCs will fail. They will fail for a number of reasons. The simplest of reasons is that they just cannot keep up with the innovations taking place in crypto, in the token economics. If you take any of the cryptos, you take Solana or Tezos, each one of them have anything between 300,000 to 1 million developers, programmers, application builders working on them at any one time. And if you see all the work, and I'm familiar with what's happening on the CBDC front, I actually know the people who are working on it in China, in the Bahamas, and then now I'm in Uruguay. By the way, Uruguay was the first country in the world that had a CBDC pilot a few years ago. I think it was 2017, and then they called it a success, and they quietly put it away. And so I'm meeting the governor on Monday to ask him, tell me a little bit more of what actually happened. And the same way, I'm actually talking to other governors as well. And this is the thing about CBDCs. The central banks discovered a technology that potentially gives them the ability to digitize money, which is fine, which is a reasonable thing for a central bank to do. But then they ended up creating a system which they themselves are scratching their heads and saying, wait a minute, this means that we disintermediate the very banks that we regulate. Right. So if you run a CBDC through the central bank direct to the user, you don't need the banking industry. And then they say to themselves, never mind, we'll still run it through the banking industry in order to support fiat and also support credit creation. There's something about central banks that people outside of the central banking industry may not fully appreciate. They have love fests. They love things that they share together, and this is central bankers from the US and China at the same time. They love each other, right? And they meet every year in a place called Basel, called the Bank for International. They have the annual meetings, and they say, okay, what is it that you guys are, each of us are doing that we can copy from each other? And one of the first things they copied before was this thing called inflation targeting, right? It started in New Zealand, and then today every central banker in the world wants to do his own KPIs and define his job description as keeping inflation within a certain band. And then when Y2K came about, central bankers said, "Oh, this is the most important challenge that the banking industry is facing. Let's deal with it." And then turned out to be a non-issue. So today it's CBDC. So firstly, they're not able to keep up with the technology, the development of the technology taking place. Secondly, the development of the technologies from the ground up, because of the API revolution, because of open source, central bankers need to think of a system where the man on the street develops the infrastructure for payments, not not built from the top down. And CBDCs are built from the top down. And thirdly, I'm also saying to commercial banks, something, in the same way that Kodak should have given up its 35 box, the yellow box that was famous around the world for many years, when digital cameras were introduced by Kodak, by the way, in 1995. By 2001, Sony had put digital camera in the hands of everybody, every tourist around the world. But Kodak was still selling its 35 physical film, and by 2010, Kodak went into bankruptcy. So I'm saying to the banking industry that, you know what, look at your most beloved of products, and that's the deposit account. And say to yourself that this is the product that we need to give up. And every bank will look at itself and say, no, that's wrong. That's like unthinkable. And then when you think about where people put their daily money, the digital wallet universe has been growing. It's been growing in the fiat world, which is digital wallets of digital banks, and then on platforms like in China you had WeChat and Alipay, which had much larger float on their digital wallets than the banking system had of retail deposits in the banking system. So then you ask yourself, what is it people really want with your deposits? They want to be plugged into the rest of community. They want to be plugged into digital life, not digital banking. Nobody wants a bank account. People want to live their life. Nobody wants a mortgage. They want a house. Nobody wants an automobile loan. They want a car. That sort of thing. So banks need to think about which of their beloved product is scheduled for a transition. And I'm saying to banks, imagine a world where every bank in the world issue their own stable coin. That the idea of fiat money is validated by the banks, backing their respective stable coins against their own balance sheet, right? And when there's stable coin, they're actually allowing their customers to go out there and function in the digital space, in Web3, to buy NFTs, to stake, to whatever that's happening in the digital space. And that's where a bank becomes relevant to the digital economy, to the network economy that we are entering into. And the nice thing about stable coins is that they can be regulated. In fact, they're already being regulated. In the US, when you issue a stable coin, the OCC says that you fall under deposit-taking business, and we will regulate you. And that is a more functional idea to CBDCs. That's what my thinking is, okay? Now, I'm happy to be challenged. And in the same way that some technologies didn't take off, when you think about nuclear energy, there was a time where there was lots of literature on saying how nuclear was going to drive entire world. We're going to have nuclear-powered cars. We're going to have nuclear energy for electricity and so on. And it didn't take off because of maybe three reasons. One is the technology itself was not perfected, which is the engineers were doing a very bad job managing nuclear power plants. And there were at least three. There was Chernobyl, there was Long Island, there was, and Sendai, entire meltdowns, which is so graphic. Secondly, regulation. The regulators didn't know what they wanted to regulate about nuclear energy. Thirdly, there was public perception, there was public pushback, right? And now nuclear is coming back because the European countries are saying that, how did we end up in a situation where we are beholden to one country on oil? Okay, so in the same way, there will be technologies that will not take off in the digital finance space. And I think that CBDC is one of them.
Wow, that's amazing. That was a great takedown. I came to a similar conclusion, although I guess I had a worst case and best case scenario. And on the best case, I think it was essentially kind of what you're describing with the stable coin, except essentially the central bank digital currency playing that role of stablecoin. But the main problem, to your point that you mentioned out, is that intermediated requirement, which is just ridiculous, right? It kind of is antiquated. It throws out the whole purpose of having digital currency, which is to have that peer-to-peer functionality and to not require the intermediary. So I'll just say quickly, and this was from, I believe, Fed chair, I always forget it, Paulson, or the current Fed chair.
Jerome,
sorry?
Jerome Powell. Yeah.
Jerome Powell, that's it. So he had 4 requirements for the American central bank digital currency that they are still exploring, right? So the first and foremost, as I just mentioned, intermediated. So basically they want to make sure the banks get a cut of it, right? The second one is that it has to be ID protected, which they frame as being privacy, but at the same time, it's saying that you're going to connect your personal SIN number essentially to your central bank digital currency, which is the opposite of privacy, right? Like you're basically showing the government like your every transaction basically at that point. And then transferable, which is the obvious one, being able to actually transfer peer to peer. And then the fourth one again is ID verification. So he kind of hit on the same point twice because on one he's talking about ID protected, but then at the same time it's ID verified. So I don't know how they square that circle, but
so as I go through all this literature that's been created, what baffles me amazingly is how disconnected central bankers are to the rest of society. It's not just central bankers. In this case, in the US, it's Jerome Powell is probably just reacting that his colleagues are thinking about it. The person driving it in the US now is Janet Yellen, whom I have I've met before, and I have great respect as a central banker, but as a technology person, what in the world is she talking about? And you are in Canada, and there's not a single Canadian would trust a central bank digital currency after what happened at the truckers' riots like last year. Right? So if a government can switch off your bank account, how much more will they be able to switch off your CBDC? And there is nobody in Canada who would trust central bank digital currency, and yet the central bank, the central bank in Canada has had several experiments on CBDCs. Maybe some of the CBDCs at the wholesale level might work, but even there are other alternatives which are far more ready to run. And basically, what central banks are trying to do is to retain the power that they have. That last point, which is that public perception on CBDC is questioning the power that this gives the state. And public perception is not just in the US or Canada, it's also in China. Because of the lockdowns recently, ordinary people are saying, you know what, we shouldn't let our government do what it does. We should start thinking about how we can put government or the state in its place in terms of the authority it has and the functionalities that it has. So I think that it's interesting to me, someone who's within the industry, to see how central bankers are issuing all these white papers with no cognizance of what the feel of the ground is or what they're trying to deal with. So it's very, very interesting. And for these reasons, I say that it's just a technology that will go away because the new technologies on DeFi are working out so fast that they will make them irrelevant. And the analogy that I use to explain this is this: that in New York, when the automobile was introduced, all the rules of the roads were built against the automobile, not against the horse-drawn carriage. Because the first cars that came out, the Ford Model T, they were heavy, they destroyed the road, they were noisy, they were uncomfortable, they were slow, they disrupted the horses. Okay, and so you think that all the regulations should be against the automobile. But then slowly the automobile became faster, quieter, lighter, and so on. And each of the regulations started to look silly until they were not needed anymore. So that's actually what's happening in DeFi right now.
Wow, I couldn't agree more. And yeah, I mean, ultimately, it's these central bankers are just not technology people, and it's clear to me every time they try to describe the benefits of the central bank digital currency, it just seems antiquated because they're still trying to prop up this old banking industry, which, to your point, is at that stage of the ice manufacturers, and we're all going to be making our own ice in our own houses soon. And we're not going to need that whole contraption. Maybe one element of bankers will still be required. People still want maybe a savings account or a main deposit account. There'll be a place for them, but you would hope that they should be looking at this innovation from a perspective of embracing it, and you would think the first one or two banks to actually embrace it and create, like you said, maybe it's a stable coin, maybe it's even just being like, we are the pro blockchain bank, like we will support your stuff, obviously KYC, making sure security things are in place, but we are pro blockchain. We're not going to shut down your account because you take $10,000 worth of Bitcoin or something. I would think the first banks to do that would be positioned for this new transition and would be able to take advantage, but instead they're just ganged up, like you said. It's a love fest. And them and the central bankers, like, how can we slow this down? How can we pump the brakes on this? It's mind-boggling.
Yeah. So it's just one of those things that will evolve over time, and it actually evolves in tandem with how the different I call them institutions juxtapose with each other. The US is the country where the tensions between the state, the large business, and the individual is at its biggest, at its most tense moments. Okay, because the US is the only country where I call them ultra high net worth individual. It's a phrase for very rich people. Have got as much power. If you take Jeff Bezos or whoever. Okay, Elon Musk can throw his tantrum around in the system and be a player who might well shape the future of the industry, just as a state would. In some countries, it's the entrepreneur who is stronger than the state. In other countries, it's the state that is stronger than the entrepreneur, and so on. But in the US, all of the different elements, the state, the entrepreneur, the individual, each have their own power. And juxtaposed with each other. That's what's shaping the U.S. today. And that's why we should let the dysfunctionality play its course. Yeah.
I like it. This is really awesome. This is great. This is the conversation I was hoping we'd have. It's really interesting to see how America is kind of playing that course, and it's exciting because there are major players who I think are on the right side of it. And, we've all got our own political perspectives, and no party is perfect and all that kind of stuff. And definitely on this issue, it seems like both parties, there are some who hate Bitcoin and blockchain, and there are some who see the value in the innovation, which is interesting. And even here in Canada, it's actually not as much of a conversation here in Canada. And I hope you're right about the CBDCs. We're very lackadaisical people when it comes to our government in Canada. So I don't know that we would be filling the streets to oppose it, but I think it just comes down to what the conveniences are.
On the day that a paper goes up to the legislature to approve the launch of the CBDC, let's see what happens in Canada.
Okay, yeah, we'll see for sure. I'll be opposing it, and I hope others will loudly oppose it as well. It just doesn't make sense personally to your point.
You are a laid-back people until someone builds the pipeline. Okay?
That's true. Yeah, that's true. There are certain lines we don't like to have to cross, for sure. I was curious, do you have a favorite blockchain? Are you kind of partial to Bitcoin because of the network effect and kind of its reliability? And if so, why?
I take my cue from people from within the industry, and everything that I've heard reinforces the idea that blockchain is the technology that's going to take us forward. Bitcoin is the technology that's going to take us forward. I'm not technical, and so I don't know enough about what I need to be looking out for. But I think hash rates are one of the elements that we need to be mindful of. Now, in the paradigm that I gave you, which is, we are in transition from the network phase, from the markets phase to the network phase. when something like Bitcoin finally finds its utility in the network phase, it may well be that the price of Bitcoin may have crashed forever. So it's not these two things don't run. They don't validate each other. The price of Bitcoin and the use of Bitcoin. It may well be that the technology becomes more well developed, the more liquidity there is in the marketplace, and less people holding it. So that may well be one of the elements that need to take place. I do have Bitcoin, and I've actually concentrated more of almost all my crypto investments. I was experimenting a few other investing in a few other tokens, but I've now consolidated them into Bitcoin because I think there will come a time when the institutional investors in Bitcoin will carry the price in the market's phase, right, where assets go down in value while investors are collecting, and then the investors will then push up the value in order to exit at some point. So there will be a point where Bitcoin will find will spike again in terms of price, and I think I'm waiting for that, and I probably exit at that point because after that. The current story, which is that Bitcoin is today attracting institutional investors as part of their portfolio, will play its course. And then after that, we will need to look for what's the next driver of Bitcoin as an investment. All of that is market phase. The network phase, Bitcoin as a utility, I will need to look at what are the functionalities being built around it. The robustness of the crypto, that it becomes essentially a digital version of gold, right? That is cannot be and then the applications, right? So that's another story, and the two stories are not related to each other, and that's how I play it in my mind.
For sure. Yeah, definitely. It makes sense. The practicality is more important than the price point, right? And when you look at, as somebody who's been speaking to central bank governors and really looking at that kind of top level regulatory approach to this space, what do you think about El Salvador and the adoption of Bitcoin as a official tender? And do you think that's a trend that we're going to see more of?
So I have been in El Salvador. I've spoken to a few, senior people, and I've been to Bitcoin Beach. I've seen how it's transacted. I learned a lot. I learned a little bit about, how adoption actually works. So during a time when the price of Bitcoin was fluctuating dramatically, there were, people in Bitcoin Village who were using Bitcoin for their livelihood. And I said, aren't you afraid to hold on to your Bitcoin? They said it depends on what your liabilities are. So if you're paying your rent in Bitcoin, so you don't worry about collecting Bitcoin for, and this is what the girl who owns the bar on the beach, she has no problems collecting Bitcoin as payment because her rent is substantially in Bitcoin. So if your liabilities are in a certain token, then you have no fear of the assets. And I think that around the world, this is what we need to look out for. Not just that people are sending Bitcoin across to each other, it's that they need to pay in Bitcoin or in crypto. So that's one element that we need to look out for. The second element is that it is not true that remittances are cheaper when you do it in Bitcoin. So the one industry that El Salvador thought that would drive the adoption of Bitcoin was the fact that it's a remittance economy. I think they get about $40 billion a year in remittances from El Salvadorians living in the US and elsewhere. Yeah. But and the charges and the gas fees and so on just makes it not viable to make. In other words, crypto is not much different from other forms of remittances, and that will need to change if there's going to be wider adoption. And the government is still going ahead with its belief in Bitcoin, partially because it made that position clear that it's that Bitcoin is currency just alongside the dollar in El Salvador. It has attracted a number of Bitcoin developers, Bitcoin-related developers. So it's actually creating a small ecosystem
Industry.
now. Industry within the country, which wouldn't otherwise exist. In other words, the country does find it difficult to attract investors, but this is one area that it has started to see some form of acceptance. In fact, for the sake of a country like El Salvador or any other country that is thinking of adopting Bitcoin or crypto, I would say it's best that the valuations remain low for a while, so that the country enough time to build enough infrastructure and low and not volatile. Because when it's volatile and it's and the stakes are unmanageable, these countries will not be able to stabilize the use of Bitcoin in the economy.
The loss of liquidity, right?
Yeah. So I think that when it's low and manageable, it gives them enough time to build the infrastructure. And the countries that have implemented CBDCs, and then I've also been privy to countries that had to go into digital banking many years ago. Any form of adoption requires marketing input. In other words, the party that is trying to popularize a certain platform or for certain payment methodology. And I'll say this to your listeners: anyone who's starting off an NFT transaction platform, the first 100 transactions will have to be fake. In other words, I'm saying fake, but what I'm saying is you got to be forced. It needs to be something that is unnaturally forced through. For CBDCs, the countries that are experimenting and have pilots in CBDCs, they're experimenting them with coupons, with vouchers, given to local population to go out there and spend, and those vouchers are sponsored by the state. But there are no states that are able to spend marketing money to see a transition to a new platform as a large business can. Like Amazon, in the early days of Jeff Bezos had to do the transactions himself, and he's forced to and get his friends to use the platform and so on before there's critical mass, and then the transactions, the average person would trust the platform like that. So the same thing applies for any form of transitions made in areas like payment or transactions in finance. And some of your the entrepreneurs on this podcast will appreciate what I'm saying, that you actually have to spend marketing money to drive it, and that's something that El Salvador doesn't have either. So it's not just making it happen or putting in place the laws. You got to make it happen.
You do have to build the hype to get that network effect. That's why FTX was spending $100 million on celebrity endorsements. That's a really great point. On your point about remittances, I don't want to gloss over that, because I think that is a really fascinating aspect of a value of Bitcoin and really of blockchain. On the Lightning Network, wouldn't it be quicker and cheaper to do remittances over the blockchain as opposed to like a Western Union or a traditional FX rail? Wouldn't that be the case?
Yeah. Well, firstly, Lightning Network, the value of transactions are much smaller, and I noticed that even I have a Lightning platform on it. I use a Lightning platform, but I use it for highly localized transactions rather than for remittance, which is cross-border and maybe larger amounts of money.
So the fees are still high, even on Lightning. Like if you're sending $10,000 to like West Africa from America, it's going to be relatively high still.
It depends on which platform you're using, and that's where you got to leverage, because different players charge different fees, and sometimes you might want to, transact with a trusted party who then, might actually have a free transaction cost in the country in which you're sending it to. It may be country specific. Like Zimbabwe, for example. Bitcoin, people collect Bitcoin aggressively. The fees are high, but the risk of doing a fiat transaction is even higher. So I think that that's where the comparison is. So it's not even a matter of the fees being high. It's like compared to what?
Right.
You know,
And the speed too, right? So you get it quicker plus the fees. I just know there's also the stablecoin option, right? Which would be more so usually on the Ethereum network, but it could be even on a Solana network, which is a little bit going through some tougher times these days. But looking at the Ethereum network and programmable currency, right? And I've sent and received stablecoin USDC as payment over blockchain, and I've compared that to a PayPal or even a bank transfer, and both the fees are, you know, maybe comparable, maybe even slightly higher, but for the speed that you get it, like with PayPal, especially if you're not doing it regularly, they hold your money for like a week or something silly, depending on the amount, right? Whereas when it's direct over blockchain, it's like near instantaneous, and maybe there is like a $10 fee, which might be like $5 more than what I would have to pay to PayPal, but I also get it quickly, like right away. So it's kind of worth it. So overall, I just think the innovation on the remittance side, on the international payment side, is a huge benefit of blockchain technology. So I just thought it was an interesting point that you didn't agree necessarily that remittances are a good use case for blockchain.
Yeah, you know, the thing about remittance is that I think that you know, the itinerant worker, the transient worker who migrates from one country to another, he is not necessarily price sensitive because there may be other factors that determines fee. Like if he needs to make you know, Western Union transaction, he might need to go into town and
Right, exactly.
bus fare included, and so on. The cheapest fee, the benchmark fee for international remittance is something called the Hawala system, which is practiced in different parts of Asia, which the regulators then came in and started to, you know, punch down the regulation on them. Basically, it's a trust system where you have instant transfer. And there's no technology involved, you know. So if you're a worker in Dubai and your home is in some village in the Philippines, you know, you can actually make the transaction at a Hawala center in Dubai, and then your family in the Philippines gets the money almost instantly, you know. And there it's basically people trusting each other, right? So and his family, you know, like you need to study how the Hawala system actually works, and it's not technology centric. You know, and then use that as a benchmark to any other form of payment that wants to match it in terms of price and security.
Okay.
You know, so in a lot of things in payments, the technology, the forms, they already exist. It's just that the regulators come in there and add the cost of regulation, and then you know, and then confuse what is it that we're dealing with. You know, are we dealing with the technology, or are we dealing with you know, the compliance costs? So you know, that's what we are up against in Bitcoin. I think that gas fees and transaction fees will increasingly go down as there are more players in the sphere and willing to, you know, absorb some of the costs. You know, I think the general direction is it gets cheaper.
Cool. Yeah, no, that's interesting. And I'll have to look into the Hawala system. It sounds really interesting. But yeah, the global transfers, like I just look at my dad. He sends money to Sierra Leone and West Africa. I think he's still using Western Union despite me, you know, talking blockchain to him all the time. And I think the only sticking point is the off-ramping, right? For my cousin or my brother out in Sierra Leone, being able to actually turn that into their local fiat. I think that's where we haven't quite confirmed exactly how that would happen, although I'm sure it's possible. But overall, I think on the cost and on the speed, I did the math and it seemed like a better option, but we'll see. One day I'll get them on it.
Actually, that's the same struggle that central bank digital currencies are facing. Like the countries where it's already live in the Caribbean, the biggest problem is the point of sale. At the point of sale, you know, what is it that the merchant is willing to use to accept the payment? And in a lot of places, you know, it's a question of whether the merchant wants to invest or whether the financial institution will give him the device that can do the acceptance. And in the case of CBDCs, I think many governments that are thinking CBDCs haven't thought it through the end into the very end where you know, where the rubber hits the road, which is at the point of sale, who's going to pay for the, you know, the point of sale machine or device. Acceptance device. You know, in banking, the banks don't want to. They always resist it until they have to. and so on. And they resisted. At the same time, they want to hold on to their legacy devices. So just imagine this, right? QR codes. The reason QR codes didn't take off originally was because Visa and MasterCard insisted that all transactions must be done on a physical terminal, and they reinforced the hardware technology on the terminal to reinforce the power that the banks had over the merchants. Okay, so they use chip cards. They have dual authentication and all that on the device. When QR codes was the simple alternative that existed for a long time. And what Visa and MasterCard told the central banks was that, QR codes are not safe and so on. Now, it was only when the Chinese players, Alipay and WeChat, said, you know what, we don't know what the risk on QR codes are, but we'll just put it out there and see what happens. And the risk was really very low, almost negligible. Technology was robust. And so QR codes became ubiquitous across China. You would see photographs of, and I've seen situations where, the beggar on the street prints out a QR code and says, you can WeChat Pay, and these are real situations. I've seen them. It's commonplace. And then Visa and MasterCard came around to saying, you know what? Okay, let's work out a technology where we use QR codes. So I think that the battle of acceptance in payment is at the point of sale. And the simpler it becomes, the more it disenfranchises the incumbents who don't want things to change.
No doubt, no doubt. Yeah, the technology continues to evolve. Those APIs continue to evolve to make it easier for people. Second last question. I always got to mention the metaverse. At Web3 Warriors, we're really excited about the potential of really stepping into the digital space and the idea that this metaverse is creating basically a whole new layer of the economy. And in a lot of ways, you've seen it with NFTs already and the insane amount of liquidity and investment and money that just basically created GDP out of nowhere. What do you think about the metaverse and the digitization of society from that angle? Is it a good thing, bad thing? Does it kind of play perfectly into your transition that you lay out in your book?
Very clearly, a lot of society needs, a lot of interactions in society needs to be translated into the digital sphere, and the metaverse captures the ecosystem very, very well. And the more technology that we put into it, the more it augments reality. And we see the first iterations of that in gaming. The interesting thing is that as it evolves, it presents problems that need to be solved. So the thing about gaming is that the reward mechanism is a tokenomics problem, which is that the incentive to game only exists if there's an incentive to profit rather than to enjoy the game for itself. So when we enter the metaverse, ecosystem, the incentive to participate should be for non-financial reasons. It should be for practical reasons, like it's efficient. It augments what we already see, like for surgery or something like that. Something useful. In addition to the idea that there's this financial incentive to participate. And I think that we need to tick the boxes in terms of some of the practical issues that are arising as the technology evolves. The fact that we will have an augmented reality is there. I mean, anyone who can dream can also exist in the metaverse. Okay, right. So if dreams are part of our reality, then the metaverse should be. There's no question that it will be. It's just that how it will evolve in a way that incentivizes the participants. I think that that's something that I'm trying to track. And as I said in the beginning of this conversation, is the ability of the individual to create and capture his own value in a transaction, right? So exactly. That I token and say, you know what, I'm going to give this a value of 70 cents, and I put it out there, and it's a question of who is out there willing to accept the value that I put into it. In the case of SBF, he put a price to his FTT tokens, and the market was willing to accept the price. So he created a whole reality which was essentially a deception. It wasn't even a reality, right? So and then it was an increased deception because he used that deception to create another deception, which is to leverage the assets created and then create a fake economy that he couldn't sustain. So we're going to go through all of these, and it's easily 100-year transition. This how the metaverse will coexist with reality, and how it will take place, and there will be setbacks that will push us back, and there will be laws against metaverse, coming up until we try to resolve that. So these are very, very early days in the technology. Now, in the same way that blockchain, for example, is not a panacea for all transactions. Like in my book, I said banks have to be very clear about what they do, which is basically industrializing what they're doing, digitizing what they're doing, and personalizing what they're doing. There are three different agendas. And anyone who's using blockchain to industrialize is probably talking nonsense, because what you're not doing correctly in the physical sense, you will not do it when you put it on a blockchain.
Right, exactly.
So 90% of blockchain pilots done by I would even say 95%, I'm just giving enough space for the benefit of the doubt, are going to be failures, are all failures, because there is no need to blockchain a transaction that is that is not going to derive any value against what you do physically. In fact, I have a section in my book where I say blockchain killed in the back office. Because in the case of financial institutions today, the fear against fraudulent transaction is so high that they have invested incredible amount of energy in compliance and risk management. And none of these compliance people are going to allow a $100 million blockchain transaction. They would allow a $100,000 transaction just for a pilot. But the moment it gets into the realm that they need to look at, it becomes manual. It becomes intermediated. Right. So you never needed a blockchain transaction in the first place. The only proven use of blockchain at the moment is in finance, is in decentralized finance, and everything else. It's taking time, developing. So my friends at Google were putting out to me the Oracle problem in transitioning physical product into the digital space, which is an interesting perspective. I think that to some extent the Oracle problem has been resolved, but anyone in the platform era will point at platform paradigm will say, well, for most things, even in decentralized finance, you need something centralized. You need a player who is your intermediary. So we're working through that transition right now. Until we totally fully trust peerless, peer-to-peer, and permissionless, paradigms.
Yeah, it's definitely continues to be a balance. And I like what you're saying as far as it's the same point you raised on Bitcoin when looking at the metaverse. It's the same thing, right? Practicality over price point. And I think what we saw, especially starting at like early last year, is a really kind of gold rush mentality, like metaverse land barons, just seeing this potential, like everyone's rushing to the metaverse. Let's just buy land and flip it and make a bunch of money. And it was a lot about the price point. And I think we've seen that kind of slowly taper off. Hopefully it never comes back, but it probably will. There will be some future bull run where people have the same realization again. But for now, it definitely has come down quite a bit. And I think from a practical standpoint, we're seeing the communities that are building, projects around actually hanging out in the metaverse for the sake of being creative, for the sake of sharing their art, putting their art on the wall, creating a gallery space where they can actually show people all of their different art collections, and then people can actually purchase them right there in the metaverse through their digital wallet, through their crypto wallet. So that's kind of practical, kind of obvious use cases that are slowly popping up. But to your point, I mean, the finance, the DeFi, the investing, and increasing your wealth, increasing your return on investment is still, I would say, a good like 90% of the entire, Web3 and blockchain space. We over here in this NFT creator economy, metaverse building space are still, a pretty small, even if it is 5 to 10%, it might not even be that much really. And it's exciting to me that even within the crypto space, I think a lot of people do have more of the financial banking perspective than the creator economy or the, let's help artists get paid kind of perspective, which is what we're kind of coming to it from. So yeah, I think it's a really interesting point you raise. And we are just at the beginning of that. So it could be 100 years. I hope it's not that long. I think 5 years from now, it's going to be a lot more ubiquitous. And I think that people making a name for themselves and making a life for themselves, frankly, being able to sell their talents and their creativity on the blockchain in the metaverse is going to be much more commonplace. So I'm looking forward to that future.
Everything that you've said in my book, I actually predicate that in the section where I talk about the creation, the capturing, and the transmission of value. How does the individual create something that he considers to be of value? What price does he put on it, and how does he transmit it? So that's what we are going through. So everything that you've just said belongs to that category of the issues being created right now, and it's a fascinating journey because in the fiat world, value is what you see as a number on the dollar. Or the currency, and there's no question about that. If I'm giving you $100, it's $100. But in the token world, it's like, how much do you think my token is worth? And there, by the way, the corollary that I relate against is the idea of community currencies, and I discussed that in the book, which is closed communities that exist even in countries with very stable fiat currency economies. And the example that I used was in Kenya, and there's a community currency project called Safaru Credit. In the U.S., there are at least 5 community currencies in local communities where you have unemployed youth working, doing itinerant work for the families in the neighborhood and stuff like that. And it can be in the form of a coupon or a trust certificate or something, a token of some kind, where they exchange that in order to hold the economy together and hold a sense of community. Now, you put blockchain into it, you put digitization into it, it starts, taking a life of its own. So there are real life examples in society today that can be transposed into the metaverse, into the paradigms that you're creating in the digital space. And then there are rules about how sustainable they are that comes from how they've worked in villages and communities. So so that's something that I spend my time on, which is to see what is the essence of banking is, the DNA of the industry, how it's worked or has not worked in different parts of the world, and then see how it's going to be transposed into Web3.
I like that. And so in a sense, we can look at these NFT communities, of which I am a part of a few of different ones, and essentially these collections of NFTs are the community currency within that collector base, right? It's like these little micro-economies. And certain artworks I have a floor price of 0.3 or 0.4 Ethereum, which is, $800. And then others might have a floor price of 0.002 Ethereum, which is like $5. And that's because the network of people that bought into this have now assigned, as a collective, this amount of value on these assets, right? So that's really exciting. And I think we are on the same page. Definitely need to do a deeper dive into the great transition and the personalization of finance that is here and that we are all taking part in. Really, really exciting. Maybe as a final question, I think you've touched on a lot of other questions I had around kind of the hostility of traditional banking towards blockchain, but I think you've really hit on that already, talking about kind of this intermediary and this idea, especially in America, but also in other countries where the established norm does not accept the new innovative option very easily. And so it's just kind of a case by case kind of evolution that's going to happen and play itself out. So Yeah, I think you answered those questions really good. But what do you say to kind of the naysayers who, I don't know, like, well, on the CBDC side, you did a great job of taking that down, but on the blockchain and more, wider, maybe mass adoption is a buzz phrase we hear a lot in the space that I'm not a big fan of. I don't think we necessarily even need mass adoption. But what do you say to those who are opposed to basically this continued evolution and to this kind of blockchain space, whether it's the central bankers, whether it's, more traditional banking people who don't agree with kind of your perspective that this is a good thing? What do you say to those people, and how do you think we work our way around those actors? Because it seems like a big hurdle,
The first thing to ask is, where are they coming from? What is the world that they are trying to protect? And what is the world that they are familiar with? Paul Krugman just wrote a piece in the New York Times saying that blockchain is total rubbish. In fact, your listeners should go out and look out for that article that I think was just last week. And it was talked about by my friends in New York. And New York Times, again, Paul Krugman, and Nouriel Roubini, creates his, extends his usefulness by just attacking blockchain and crypto nonstop. And these are economists, and I must say that economists have it really bad. They are really bad adjudicators of the future because they are trying to safeguard a perception of how the economy works that comes from each of their respective biases. Right. If you're an open economy person, you have a certain bias. If you are a control economy person, you have a different bias, and so on. So economists make very bad purveyors of the future, and then central bankers have an innate desire to protect the existing bank-centric intermediation model for as long as they can, because that's the only model that they know on how to pull the strings to steer the economy. In many countries, central bankers manage the economy by releasing or tying in the capital requirements of banks in the country, and they don't know any other mechanism. So the first, really, to deal with naysayers, always ask yourself, where is he coming from? Is he coming from a central bank perspective? Is he coming from an economics perspective? He couldn't possibly be coming from a technology perspective, because anyone in technology will be able to appreciate that what used to be an Excel sheet then eventually became something that you shared in a closed network. And what we call a shared ledger today is that you and I and everyone in the transaction have a view of the same Excel sheet. And that's a natural evolution of data or database. So then the question is, will it be evolved so much that it will affect how we are organized as a business, also as a community going forward? So I think that just knowing where they're coming from will be able to help you understand where the resistance is coming from, and then work out whether they are right or wrong. And as I explained to you, I have now decided to neatly categorize them as dealing with one of the four aspects of human evolution, which is, are they tribal? Are they institutional? Are they trying to protect the institution? Are they markets? Are they dealing with something they understand? You do not argue with Warren Buffett on markets, and if that's what his perspective of crypto or blockchain is, then that's where the problems are. I mean, and crypto does have a problem from the market's perspective, and then whether we're dealing with the network world, which is a free for all at the moment. You and I can both pontificate the future of metaverse, and neither of us are neither here or there. Right. So I think if we go back to first principles of where they're coming from, we'll be able to understand how to deal with it. My own conclusion is that we cannot deny the march of technology, because I've seen how the transitions have taken place in recent times. I tell the people at Google and at Facebook that remember there was a time from 2007 to 2010 where Facebook thought that it was a desktop application. And Facebook nearly didn't make the transition into mobile when it became fully developed by 2010. And that's why the Chinese players who were native to mobile were able to move much faster. And the first iteration of Facebook on mobile was actually tentative. Facebook didn't think that it even needed mobile.
Wow.
And the nature of legacy thinking in US corporations is highly developed. Okay, they are far more formidable than we imagine. We think that these players are following the technology as it evolves. They are not. And this is the year 2022 when Facebook has started losing. The total number of users are in decline, while there's another platform, TikTok, which is on the rise, and that's because they are far more mobile native than Facebook. But even there, TikTok is up against Internet of Things, the fact that we are device independent. We're going to be device independent soon, and then we have got the metaverse. How is that represented on a device?
Right.
And TikTok might well have a shorter lifespan than Facebook, and so on. So this ability to accept or to ride the transitions is not as natural as we think it is.
Yeah. Wow. It's a very interesting concept because people do just assume everyone's following the technology, but it becomes clear when you actually look under the hood. A lot of people are doing the opposite and trying to oppose the technology and really having problems evolving with that.
And the same reason applies to technology players as it does to bankers, because they're paid very well.
Right.
They're
just dollars and cents.
That they can't help but think that they're doing something right with their lives. It's the money that gets everything out of proportion. And that's what I say to my banker friends, which is the reason that you cannot see a world where intermediation is thrown out of the window is because you are intermediation.
Right.
You are ridiculous amounts of money to stand in the way between a buyer and a seller. And it's the money that makes them believe in what they believe in.
That's it. In the NFT.
But yeah,
in the NFT space, we say no more gatekeepers. And I think in the finance space more broadly, we have to say no more intermediaries. It's just not necessary. We're peer-to-peer. That's the solution. That's amazing. Thank you so much, Emmanuel. I think we've got a lot of great value from this interview. I don't think we have any final questions from the chat. I want to appreciate everybody who's been watching on the live stream, and we'll have this podcast all fully edited and up on the podcast networks by tonight. One other thing I was just going to ask, do you think that there's one jurisdiction that is actually preparing for this transition really well, or do you think everything's just a work in progress? Is there one that's really impressing you?
The jurisdictions that have put in place the rules or the laws that helps the transition are more likely to absorb them as they happen. And I think the UK and the Eurozone have got concepts of open banking in place. And open banking is about allowing the end user greater control over his own data and deciding who he wants to share his financial data with. And when the UK put in place open banking laws originally, it's a few years ago now, strangely enough, the ordinary UK citizen showed that he continued to trust the bank more than he trusts any of the new players coming on stream. Yeah. Okay, so that was the original iteration. And then, to earn the trust for financial services outside of the banking industry is really, really difficult, slow, tentative, and it will take time to take shape. Currently, I would say that the Singapore regulators and some of the Asian ones like Korea and Japan are far more enlightened in terms of how they want to play the crypto game. They love the technology, but they don't like the the trading and the leveraging and the risks that it potentially means to the savings of the domestic, of its own people. So what they don't like is when it touches personal investments of ordinary people. But the technology itself, they are fairly open-minded. And then you have the Dubais and the Abu Dhabis of the world, which doesn't want to be left out, which opens up their regulation as broadly as they can, but they themselves have nothing to offer.
Right. They just want everyone to come there to start building in their sandbox, right?
Sandbox and then and see how it works. Now they run the risk of allowing charlatans into the and bad actors into their ecosystem, and then see how that works. And then there are the Caribbean players, which I find very, very interesting, and I really feel sorry for them because many of the Caribbean countries have got very small populations, like 200,000, 800,000, 1.2 million. That kind of thing, and they are, thinking of how to play this, Web3 world, because they've done well in the wealth management realm by being, tax-free havens, which are now becoming increasingly regulated, but they have very few ideas of how to build on that, and that's why SBF found favor with the Bahamas regulator government. I said, well, you know what? Nobody else will have you, so why don't you just come here and see what you can build? And they did not know any better than to read popular literature saying that SBF was fine and that this is a huge player in the market and so on. And then when the shit hit the fan, they have to fall in line with the U.S. regulator. So none of these Caribbean players would do anything that would get them in trouble with the U.S. regulator. So that's the regulatory, the profile of the different regions and how that's evolving. Because El Salvador started by being forceful about the fact that it trusts Bitcoin, and it would stand up against the IMF, the International Monetary Fund, and the World Bank. Several other Caribbean countries or Central American countries, all of its neighbors, are very interested in what El Salvador is doing. So you find that they are far more receptive to ideas, although their regulation may not be in place at all yet, but they're getting there.
Definitely work in progress. That's really exciting. This has been an amazing kind of philosophical discussion on the future of the personalization of finance, but also just blockchain, governments, regulatory perspectives. And I really appreciate the perspective you come with, Emmanuel, and the fact that you've actually talked to these governors and regulators in different spaces. I noticed you have a couple high-profile politicians on the forward of your book there. So you're definitely talking to the movers and shakers and trying to influence those people in high places that need to get on board with the innovation and see the good side of blockchain. So I appreciate the work you're doing there.
The person who wrote the first forward is Barney Frank, who co-authored the Dodd-Frank Act,
right.
Which today, and he's a very dear friend. And he starts his forward by saying, "This is a tough book," in the very best sense of that word. So I think that he read the book.
It's tough reading, especially for those who are a little bit more hesitant with this new technology. Well, thank you so much, Emmanuel. This is kind of our final episode, actually, of season 2. Each season has 22 episodes, so this is episode 44. And it was a really great way to cap off this season, really looking at the future of the regulatory approaches around the world, and really what it means for us. And open banking is the word. I think that is the phrase that we should all be carrying with us into these conversations when looking at CBDCs, when looking at all the stuff that the central banks and the other traditional banking financial institutions are trying to throw our way. Like, we deserve open banking. We deserve, a true peer-to-peer system. We know the technology is there. We know the benefits of the technology. These intermediaries are, they'll have their role to play, but it should be as minimal and kind of hands-off as possible, just helping us save our money there and do whatever we need to do in those institutions. But I hope that things evolve the way that you see them evolving, and that people like us can continue to push for that open banking, and we'll get it. We'll get there eventually. Was there any final words you wanted to add before we shut her down here?
Anyone who wants to know how my own thinking evolves, the funny thing about writing a book is that the person it transforms is the writer himself. So I've come up with, a very clear perspective of what will work and what will not work. So like just now I said that I truly believe that CBDCs will fail. I also think that, financial inclusion as a concept is a lie. Now you'll find all of this on my blog page, which is emmanueldaniel.com. So any ideas that I develop as a result of having written this book, do go and catch up whatever I've got listed on my blog page, Emmanuel Daniel, and also on my book. You'll find more information on that from the blog page onwards. So thank you very much for this opportunity, and Merry Christmas and Happy New Year to all of your listeners. Great way to end the year. I didn't think that I'll have this conversation with you because I'm not technical, and the geeks in Web3, understand a lot of the technology better than I do. But because I come from the traditional world, I help to translate that. So, happy to continue learning.
No, you definitely helped to translate, and Merry Christmas to you as well, and Happy New Year. I'm definitely looking forward to what the new year holds, really. And it's really exciting what you've kind of highlighted here. So I think I'm not a technical person either. I'm coming to it from a creator perspective, from a fan of the metaverse, from the fan of the digital space, really, and the idea that blockchain has given new value to the digital space that just wasn't possible before. So that's where we're coming from. And I think that you're hitting the nail on the head as far as the actual societal impacts and the real, financial economic trends that are, part and parcel of what we are building here with Web3. So appreciate you, Emmanuel. Maybe we'll have you on again. Maybe you got another book coming out. So we look forward to it. Everybody should go to emmanueldaniel.com and check out more information about his book and find the link there if you're interested in ordering it. Appreciate you, Daniel.
Thank you very much, David. Thank you for the opportunity.
And until next time, we'll catch you all in the metaverse. We'll be back next Saturday, 12 p.m. Eastern, talking decolonized finance. Peace out.